Welcome back to Nasdaq Trade Talks. We're coming to you live from the 85th Annual STA Market Structure Conference. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Ellen Green. She's the Managing Director over at SIFMA. Ellen, it's great to see you again. All right, so let's talk about SIFMA. What's its role in the industry?
Our role, Jill, is really working with our members, broker-dealers, investment banks, as well as asset managers,
right,
and really working with them, understanding what their issues are, and advocating with the regulators on their behalf, and really working through rules such as our best interest standard and other things now. And I think, Jill, as you know, my role is one of my roles staffing the listed options trading committee, and I'm hoping we can talk today about some of the issues that we spoke about the last time.
Yeah, I was going to say, last time that we had met at OIC, we reviewed some of the ways that the listed options trading committee is driving change. We want to learn more about that. Since we've met, can you share some of the key initiatives that you've been focusing on?
Yes, one of the initiatives we've been working on, which is rather mundane sounding but very important from a risk perspective, is exchange give-ups or universal take-ups. And what that is, it's a practice whereby an executing broker can give up any clearing firm, give up their OCC clearing number on the execution without having any sort of agreement in place with them. Earlier this year, the Federal Reserve came into a number of the bank clearing firms, looked at the risk, and really began to understand that these positions coming into their account, there's no way for them at times to identify the customer, and really no way for them to know whether this is their trade or it's going to get transferred out to another clearing firm. So what we've been doing is working with the exchanges, and we've spent many months educating on this, and really looking for them to change their rules such that we now have an agreement between the executing broker and the clearing firm that will govern this practice going forward. And I think it's important to consider that this isn't the first work that SIFMA or the industry has engaged in. Several years ago, the OCC put out what was proposed new rules to introduce pre-trade risk parameters in 4 broad categories. And long story short, the exchanges adopted the rules, and they continuously now adopt new pre-trade risk checks for both market makers who have hundreds of thousands of quotes in the market, as well as the order entry firms providing the orders into the market. So I think the exchange give-ups is really just a second phase of this project, and I think that we have a couple of exchanges with rules at the commission right now, and working closely with the other exchanges on the filings, really looking to create a standard that we think will be most suitable to reduce risk.
Do you think the new exchange rules, is that going to be the culmination of the project?
Well, actually, there is going to be a third phase in this, and so we've gone from pre-trade, and in pre-trade you also have the executing broker subject to the SEC market access rules, so that's another check there. Then we have the exchange give-ups, and the third phase really focuses on the clearinghouse at OCC, and what we'll be looking for and they're working on is the creation of an actionable identifier, which will allow the clearing firm to identify the customer that sent that trade, so they can understand whether it's theirs and just the risk associated with it. And then the second phase, so that'll happen in 2019.
Right.
The follow-on phase to that, which is probably 2020, will actually be risk checks. So the clearing firm will have an agreement with the executing broker and their customer, and that will really give the clearing firms the transparency into those positions, help them manage risk. And I think that once all this is done, we'll have a much more resilient market.
Well, I know what I'm going to be talking to you about in 2019 at OIC, but looking ahead to 2019, what are some of the key market structure initiatives you'll be looking at?
I think so much of it centers around liquidity. There's fragmentation in the markets. There's 15 exchanges with a 16th that's just filed. There's a lot of strikes, and there's really poor treatment of risk-weighted assets. And just to spend a couple of minutes on that, when Basel took effect in January 2019, the bank-owned clearing firms were no longer able to net market maker positions, meaning they couldn't take a hedged position and put the capital on top of that. Instead, what they were asked to do was to look at each position and provide capital for the entire trade. So that's been very inefficient. There's been a lot of work done with the regulators to no avail. However, Congressman Holmgren proposed legislation legislation that was passed by the House, the Holgren Option Stability Act, which would require the bank regulators to give some relief to the capital regulatory requirements for this. So we do hope that that gets some traction in the Senate. We think that rather than waiting for the new rule sacker to come into play, that this might be something that is a bit more expeditious in solving it. The other thing is, as I mentioned, strike listings. You know, market makers have hundreds of thousands of quotes out there. There's close to 1 million strikes. However, what we see is that the vast majority have no open interest in them, and as you would expect,
right,
the volume is concentrated in a few names. SPY currently has 2,700 series outstanding. So what we've been doing is working, trying to look at data and figure out a data-driven approach to create smarter listing strikes. It's taking some time, but we're now in a new effort with the exchanges and STA partnering together. We have some new data we're looking at, and we hope, some of the indications is that 2,700 in SPY goes down to 1,200 by putting in some new parameters. So we think that those two initiatives are something that would really be beneficial for the market.
Right. Well, thank you so much for joining and catching up with me. Thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.